Jitendra Sriram joins us. Anuj also is with us. Jitendra, good morning and thanks for joining us. What's your sense? Do you think, as Marcus Rosgen was just telling us, that the chances of the tapering being less than 15 million, suppose it's greater than 10 to 15 billion, there could be a severe snapback in India. How will you approach trade over the next 48 hours?
Well, that's a very valid point. In a sense, I would expect that the US Fed at least directionally will go for a lower bond purchase, and which clearly means that you will see the extent of financing of the current account deficit in India is definitely very vulnerable on that count. In fact, if you look within ASEAN markets, India probably has the lowest FX cover overall within ASEAN. So to that extent, it is clearly more vulnerable, and I would expect that in case there is any kind of bond buying easing coming through from the Fed, you will see capital flows getting stumped a little bit.
I just want to come back to that point both you and Marcus were making. It's interesting that both of you made the exact same point about the fact that the Indian markets are a little more sensitive to a flow, foreign flows moving out if the FOMC doesn't pan out as expected. But do you think because of all this volatility, this market will continue to be just a trader's market and very difficult for investors to put in money at any given point? Well,
I would say that it is a little bit like a barbell in that regard. In a sense, you have one section which has done very well, which is the exporter segment and all. If you look at over the last 5 years, most of the exporting stocks, whether it's in the pharmaceuticals or IT services, they all made incredible amounts of money for investors. But typically, these are not the stocks which most traders tend to own and have probably not ended up participating in the rally. The second half has been the entire domestic facing sectors, which have probably struggled all through this while because of the fact that India's economy has been decelerating. Well, to put it in another perspective, I would say that whatever the US Fed is taking by way of actions, it's probably going to lead to a little bit more polarization in the near term, because you will end up wanting to play DM exposures out of an emerging market. So to that extent, you will probably again end up playing the IT, the healthcare and so on in the near term.
Okay, but Jitendra, what are the chances of something vicious happening after the FOMC meet? I mean, May 22nd, June 19th. Something like that, is there one big vicious round of sell-off in India possible?
Well, I don't think that near term you could see something vicious happening, because from whatever statements have come out of the Fed so far, it seems to be more a calibrated approach to an unwind. So to that extent, it will be very, very modular. They will keep on seeing data, probably keeping on trying to tinker this process of unwind to as smooth a fashion as possible. So to that extent, I would not expect something, like a step function correction or a step function upheaval in the market. Those kind of events, I think, are highly unlikely. So it will be more gradual in its overall play out. But one other aspect, I would say that, India on its own will probably have earnings season being a little bit of a disappointment, because we are going through a slowdown phase in the economy, and to that extent, I think market is probably still not grasped on what could be the true extent of slowdown which comes through in terms of corporate earnings, which is where you will have an issue.
You track the FII shareholdings very well. What have you noticed in the past 2 weeks? Have FIIs continue to put in money in the defensive names, or are they now moving to some of the cyclical names, banking maybe?
Well, Sonia, I think that's a very interesting trend, because there are two parts which are happening here. One, I think up till recently it was pretty much going towards the defensive segment of the market. So, whether you had IT, healthcare, private banks and so on. Well, up till probably I would say mid-August or something, it was a fairly uniform trend that you're constantly seeing buying the same stocks that have done very well over the recent past. But off late, I am seeing some move towards two themes. One, some people are willing to take a 1 year, 1.5 year view and saying, okay, maybe the holy bastion, so to say, may get tested now, because it's very difficult to anticipate the same private sector banks like, continuing to grow at 25-30%, given that, the economy is in a slowdown. So whether it makes sense to look at some of the really bombed out segment in the market. The second aspect I'm seeing is there is a degree of playing the mid caps, high quality mid caps, maybe even some things like MNCs, because given what has happened to the rupee, for any company to buy out its minority in India, it's so much more cheaper now. So those themes are becoming a lot more evident. You know, today also you had an ad in the papers about Bayer Crop Science doing a buyout. So
it was dense yesterday. And
yeah,
today.
so those themes could be well at play as well.
Yeah, Jitendra, you said the earnings season will be disappointing. Any chance of earnings degrowth, and will this be the worst of the earnings downgrades then?
I would suspect that second quarter will be probably the worst of the cuts coming through in terms of the numbers. If I were to take a look at degrowth, I think sectorally, yes, there is a chance that, industrials and stuff could see degrowth as such. But at a market level, I still think we would probably end up with 6-7% kind of an earnings growth. I don't think degrowth is probably an option right now.
Okay. Would you, even at these levels, pick any stock? I mean, are you still on picking mode in IT, a sector you favored?
IT, the major name that we like there continues to be TCS because of the traction that it is witnessing overall in terms of growth momentum and so on. So that is a name we continue to like. Other than that, we think, some of the mid caps could offer some value, but overall, it's not like we fancy the whole sector as of now.
Okay, now let me come to the other one, pharmaceuticals. Yesterday Udayan put it very nicely when he said pharmaceutical is full of landmines and gold mines. Any gold mines you're still buying there?
Sun Pharma clearly is one name that is part of our Asia Super 10 as well. So that is one name we continue to like. And again, I think probably one aspect is that the traction that is coming through from its acquired subsidiary in the US, Taro, continues to be very strong. So that's one name we do like. We do like some mid-cap exposures there as well, like names like Lupin, etc., which are some names that we back.
You also like Titan. What did you make of the government hiking the import duty on gold?
Well, yesterday's event seems to be more a kind of support for the domestic jewellery makers. In a sense, it's not the raw material which has been hiked, it is more the finished good which has been hiked. So I think it is a little element of protection for the domestic jewellery manufacturing. Clearly, yes, there is some headwind which is coming through on gold sourcing, but I think to a large degree, it will probably lead to some separation between the top-rung companies and the mid-rung companies. So I would expect that Titan may end up probably gaining a little bit of market share in the market as well.
Okay, I'm going to end this segment by asking an unfair question to both of you, Jiten and Anuj. Just stick your neck out post this FOMC meet and maybe by the end of this contract. Is the index more likely to cross 6,000 or more likely to go to 5,750 or 5,700? Jiten first.
I would probably bet more on the downside, because I think both on domestic liquidity easing, I don't think RBI will make any big moves now. We are calling for status quo there. And I think on the earnings momentum also, things remain, it is a struggle.